Normally I start off a video not like this. I just can't believe this. Hopefully you guys know who this is on screen. This is the former St. Louis Fed president, James Bullard. This is the guy in 2022 that would go on CNBC or do these conferences and say, we're heading down, a wage price spiral, or we have to take the federal funds rate up to 6 or 7%, and would totally panic the markets, and the markets would sell off basically every time he spoke. And the volatility was insane in 2022. So these were like 1, 2, 3, 4% moves upon every word that he said. Wow, like I'm seriously shocked. The headline of this video says, "A soft landing has been achieved." We need to discuss this, but first you need to listen to this clip because, wow, that's a bold call. And yes, we are going to discuss Tesla, the sweet spot of September that I think we are in, and much more. But I think this is more pressing.
View the latest inflation data. Former St. Louis Fed President Jim Bullard, he is now the Dean of Purdue University's Mitchell E. Daniels School of Business. Great to have you, Jim. Thank you for being here. I first want to get your take on today's PCE data and whether it signals to you that we've mission accomplished on inflation.
This was a good report, right on track with what markets were expecting. This will put the Fed squarely on rate cut in September. And I think it's going to be 25 basis points. And I think the debate now will shift out to the November-December meeting. And I think the baseline there is 25 basis points at each of those meetings as well. And it is a soft landing, and I think it has been achieved. I think Jay Powell's speech at Jackson Hole was essentially recapping the success of monetary policy over the last 2 years.
So soft landing, it sounds like you're still expecting a gradual cutting of rates, 25 basis points, maybe some debate thereafter. What are you looking for in next week's payrolls report that could change that dynamic for you?
Yeah, I think this is, I think the debate, because of Jackson Hole, I think the debate's shifting. So now if you got a surprise in any of the upcoming reports, I don't think it would affect September. It would affect the debate about what to do later this year and focus on November. So for instance, if the payrolls report was very hot and showed a thriving jobs market, that might call November into question about whether the committee would do anything there. If it was a very weak report, let's say, close to zero or something, then you might get debate about whether they need to do more. But I think the do more would be farther out in the future, not at the September meeting, because I think they would just shrug off any data that's coming in now between now and the meeting as just one data point, and they wouldn't probably react to that.
That is just incredible. I mean, that is a statement. Considering all of the mixed economic data points that we are getting, I mean, simple Econ 101 would say, for every boom, there's a bust. We've seen one hell of a boom. There's no bust at all? There is, and it's coming. Part of the problem is the economic data that we are getting today is pretty cooked. I mean, the data we're getting is, in my opinion, reflecting the economy months ago. So, much the same way as you have non-farm payroll revisions and massive revisions because the data was incorrect. I think the data is incorrect and or delayed many months, because what we are actually seeing in the real economy is not good. I mean, go out, go talk to people. Like, that's what I do each and every single day. I'm like, I don't know if you guys ever seen the movie The Big Short, that back in 2007, they actually went to some of these areas that were experiencing the real estate problems, and they went and knocked on doors. They went to foreclosure homes and talked to people. And that's what I'm actively doing right now, is going out and talking to people. And I can just tell you the bottom line is people are not doing good. People do not think they're going to do good. People are really cutting back because inflation, right? We think about inflation in terms of what's inflation doing on a month-over-month basis. People think about inflation as far as where are prices. Oh, they're still up. They're going up, right? Because prices are still going up. And that's how they're judging their spending behaviors of what to buy. Do I buy this or do I buy that? Do I skip on this? Do I skip on that? And people are not doing well. Now, I think one of the best companies to kind of judge some of the weakness out there could be Dollar General. Because if we think about the structure of the economy, okay, people like to talk about Walmart is doing well because they're attracting the higher end customer and they're going to Walmart. Let's just be honest. Everyone goes to Walmart, okay? Unless you are ultra wealthy, you're going to Walmart, okay? Where else are you going to go for your daily products, essentials, blah, 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 okay? Even if you're a freaking Warren Buffett, you might, maybe Warren Buffett actually goes to the store himself, but even if you're, you know, Mark Zuckerberg, you know, Bill Gates, Warren Buffett, Elon, some of the richest people in the world, you may not go yourself to Walmart, but you're going to send someone else to a Walmart or whatever to, you know, shop for you, right? Everyone goes to Walmart. Dollar General, on the other hand, has the bulk of their consumer base is low income. And I want to share this part of the transcript with you. But if we're thinking about who is affected by a worsening economy first, you have to imagine it's the lowest demographic on the totem pole, right? The people earning the least amount of money. And then that usually will start to go up the cascade to the middle class starts to, you know, feel more pain. And if the higher income individuals start to feel pain, then you're in a deep recession at that point. You're in up shit's creek, okay? So Dollar General, I think, is a great bellwether of how the lower demographics, income-wise, of our economy are doing. It says here, this is the transcript from the earnings call that just came out. Dollar General fell 32% yesterday. I made a video that said, we're effed. Eventually. It's going to take some time, but we're effed. And yes, I do still think markets can move higher in the near term. And I'll talk about all of this in just a moment. And by the end of this video, hopefully you're going to have a great understanding of everything I'm talking about. But it says here, as well as our continued softness in discretionary sales and our own customer data and survey work, we believe the softer than anticipated sales performance in Q2 is at least partially attributable to our core customer that is less confident of their financial position. I want to provide some additional context around what we're seeing and hearing from our customers. The majority of them state that they feel worse off financially than they were 6 months ago, as higher prices, softer employment levels, and increased borrowing costs have negatively impacted low-income consumer sentiment. As a result, our core customer, who contributes approximately 60% of our overall sales, comes predominantly from households earning less than $35,000 annually. Inflation has continued to negatively impact these households, with more than 60% claiming they have had to sacrifice on purchasing basic necessities due to the higher cost of those items, in addition to paying more for expenses such as rent, utilities, and healthcare. So I think this is factual, what I'm going to say next. There is no better company to tell you how the lower income demographic is doing than Dollar General. 60% of their customer base makes less than $35,000. And if we think about the kind of jobs that are $35,000 a year or less, they are a lot of retail jobs. They are a lot of fast food jobs. They are the jobs that maybe Walmart, right? And these individuals feel less secure about their jobs. They're not able to make ends meet. I really feel bad for this demographic because they're also going to be some of the first people that start to get laid off as well when things get worse. Now, Dollar General goes on to say more of our customers report that they are now resorting to using credit cards for basic household needs. Basic household needs, like the basics, right? And approximately 30% have at least one credit card that has reached its limit. So we're not even talking about actually, like paying your credit card off at the end of each month, which I recommend you do. I use credit cards all the time for, the points, the rewards. You might as well get, 1.5 to 3% cash back on all your purchases as long as you pay it off each month. No, we're not talking about that. We're talking about credit cards that are maxed out, not on big ticket purchases, not on anything else, but on basic household necessities. Ouch. That's not good. It says, and in our latest survey, 25% of our customers surveyed noted they anticipated missing a bill payment in the next 6 months. And granted, these are people that still have jobs, that are still working, presumably. These are not, people that are unemployed. So when I hear things like this, I think about first principles, basic principles. Can this happen without affecting the broader economy? And I think the short answer is no. I do not think you can have this much economic disparity and not see that eventually reflected in the data. So on top of what I'm seeing, the research, the active activities I'm doing to judge and gauge the economy in real time, I'm also looking at things like this. And that's where I'm coming to my conclusion that the data is lagged behind a lot. And that's also why I'm not really concerned about the data that we're going to get in September, because I think in all actuality, this data that we're getting in September could be taking data points from May or from June, when I didn't see the worrying signs that I'm seeing in my active day-to-day research that I'm doing. But now I am seeing things that are dramatically worse than where they were just 3 or 4 months ago. And considering 60% or more of America lives paycheck to paycheck, and they're maxing out their credit cards, their bills keep going up, and they're not getting raises. Let's be honest, unless you're changing jobs all the time, which in this market is becoming hard to do, you're not getting raises that often, especially the lower or mid-range earners of our economy, say $20,000 a year to $60,000 a year. You're typically not getting raises that are going to keep up with the cost of living. So you put all these factors together, if you have not changed jobs, especially over the past couple of years, your bills are getting higher. People are really starting to fall behind. And if you're living paycheck to paycheck, paying your bills, your excess, deficit, if you will, each month on, let's say, a credit card, now you're maxing out those credit cards. People are really starting to get in bad financial shape. As Lance Roberts on X says, stocks are increasingly sure that the economy will avoid a recession. Bonds, not so much. And you can see that reflected here in this chart. This is from Bloomberg. Now, the bond market is much larger than the stock market. It depends, what the value of the markets are, what the ratio is, but usually it's anywhere between 3 and 5 times larger. So you may think the stock market's like the important market. No, it's actually the bond market. The bond market tends to sniff out bad things, or good things for that matter, before they happen, because there's much more money. Typically, you want to follow the money. And what the money is doing is usually telling you something. That's why people like to look at the inverted yield curve as a recession indicator. And when that uninverts, that means we're heading into a recession, right? It's because the bond market is typically correct and the stock market is more run off of emotions, and it's typically wrong. And yeah, the bond market is telling you a different story than the stock market. And I think part of that is based on the weakness that we're starting to see that a lot of people, including Jim Bullard, want to ignore. Even Nick Timmerhouse on X says the Conference Board's labor market differential, in parentheses here, jobs plentiful minus jobs hard to get, narrowed again and is now at a level last seen in 2017. Glass half full, this is historically a fine labor market. Glass half empty, this trend isn't your friend. And labor markets typically revolve around a trend. When you start an upwards trend, it tends to keep going. When you start a downwards trend of, a worsening labor market, it tends to continue to, get worse or get better. It tends to follow the trend. And normally coming out of recessions, you tend to see this trend upwards. Going into recessions, you tend to see this trend downwards. And there has been one hell of a trend in recent years. Now, ultimately, what matters in markets is the Fed cutting cycle, but more specifically, it's how is the economy doing? How much is the Fed cutting rates? So anytime the Fed cuts rates aggressively when the economy is weakening or doing bad, that tends to lead to a very negative 12-month forward return for the S&P. If the Fed is able to cut rates at a slow and steady pace, that tends to lead to much better returns for the S&P after the Fed cutting cycle. And that's why the economic data over the next month, 2, 3, 4 months is going to be so very important. And that's also why I believe September could be a sweet spot for markets, because if the economy's holding up, the data looks good, the Fed cuts rates on September 18th like they plan, which is basically a certainty at this point. I mean, that's a pretty bullish event. Now, the counter argument to that is, well, there's bad seasonal trends in September. As I've talked about before, September is by far the worst month for markets in the past 10 years. And since 2020, the best September we have had was negative 4.1%. The worst September we had was almost negative 10%. But seasonal trends don't have to always work. I do think this time is different in the sense of there's, there's events happening in September. There's the Fed cutting rates. There's an election this year. And I think this September could look much different than prior Septembers. But I do think this September will definitely favor cyclicals and value and small caps and interest rate sensitive companies. And that's why I think Tesla can actually do very well in September. And in fact, I wouldn't be surprised if Tesla stock could rally 20-30% in September as the Fed cuts rates, heading into the Robotaxi event on October 10th. A 20% rally from here would put Tesla stock at about 253. A 30% rally from here, I gotta zoom it out a little bit. A 30% rally from here would put Tesla stock roughly at about 274, which is pretty much what I indicated in the last video could happen. I said around 280 would be more of a realistic scenario, but that's totally plausible as long as the economic data holds up, in which I think it will. Now, take a look at this new clip on CNBC from Tom Lee that says Nvidia sell-off shows good news was priced in, and there's room for small cap rotation. Which I know Tesla is not a small cap, but it has the same similarities of a small cap, besides being, profitable when a lot of small caps are not profitable, and not needing to go out and raise capital. But from time to time, Tesla does go to the bond market and raise capital because they're investing a lot of money. So there are some differences between Tesla and small caps, but generally speaking, small caps interest rate sensitive, and Tesla is one of, if not the most interest rate sensitive companies out there today. So I do think if small caps do well, Tesla is going to do well.
So it was, of course, a volatile month with the Dow, S&P and NASDAQ carving out gains, with the Dow and S&P hovering at fresh highs. So what will September bring for stocks as we get ready for a jobs report and possible Fed rate cuts. Joining us now, Fundstrat Global Advisors Head of Research and CNBC contributor Tom Lee. Tom, great to have you with us. NASDAQ, I should clarify, will only have gains if it continues its strong session today, so it won't be significant net gains. Tom, great to see you. Long time no speak. First and foremost, what's your reaction to how the market is processed NVIDIA's numbers? It, of course, fell initially in the pre-market. Yesterday morning it was doing all right, and then it did close more meaningfully down by the end of the session yesterday.
Well, I think NVIDIA is one of these stocks that has become part of like a stock market lore. Almost everyone has a position, and I don't think the results and the earnings changed anyone's minds about AI and the central role it's playing in both global productivity, but also NVIDIA's role. But I think the sell-off tells you that a lot of good news was priced in. I think that's why the stock fell. It didn't take the broader market down. I think that was kind of a positive outcome, and I think it just shows you that there's room for a lot of rotation, and I think that it's revealing that small caps is one of the groups benefiting from that rotation.
Let's talk about that rotation, Tom, and the extent to which there's still a long way to go if you're looking at the valuations of some of those sectors that haven't done so well in recent months and years, or whether things have bounced enough across the board that you start to get a little bit concerned about valuations for the entire market, not just the NVIDIAs of this world.
Valuations are definitely something our clients are asking us about because, the equity markets have been rising for several years. But the idea of a rotation, I think, is grounded on a couple of things. One is that the Fed's rate path is lower, and that benefits cyclical stocks and small caps. And we know there's also a lot of cash on the sidelines, and investors de-risk because of the yen crisis and just general concerns about the summer. And so I think the NVIDIA results plus the Fed in September is really the catalyst that is going to get some investors to actually follow through with the rotation. So I think we're early because, for instance, small caps, I know people think they're expensive, but the median PE of a Russell 2000 stock is still 10.7 times forward earnings. That's compared to almost 17 times for the S&P. So the small caps have a lot of room for multiple expansion.
But Tom, do you want to just own the index? I mean, there's a lot of not great companies when you talk about small caps, in terms of just not just their indebtedness, but any number of other metrics you might want to use. Are you telling people they should buy individual stocks or just buy the index?
I think it's both, David. We have a lot of portfolio managers that actually focus on small caps, and they're finding a lot of really attractive individual ideas with good earnings growth. But I think there is a misconception about the Russell 2000. I know there's many non-earners, but over 70% of the non-earners in the Russell 2000 are biotech stocks, and I don't think they're meant to generate earnings. And if you look at Russell 2000 earnings in aggregate, it rose 18% in the quarter, and is projected to grow 39% in the third quarter. So in aggregate, it's not a bad index to own anyways.
Tom, I wanted to get your thoughts on the broader economic data. This morning, PCE came in line with expectations. We had GDP yesterday at 3% versus the 2.8% estimate. As we start to get ready for an interest rate cut, how much is already priced into this market?
We'll never know how much good news is priced in, but I think there was a lot of encouragement in both of the data points you point out. PCE core came in at 0.16. The upside driver there was actually financial services, which is because the stock market's up. It's showing up as inflation in PCE core. The year over year is staying at 2.5, 2.6, which means most people were thinking that year over year would actually tick up. They had negative revisions for the prior months. And on the inflation side, a 2.8 for UMISH 1 year, that's pre-pandemic levels of inflation. Consumers are always around 2.8, so I think this is giving the Fed a lot more green light to cut and focus on keeping the labor market strong, which means it's essentially acting as a Fed put going forward.
And I did want to share that because I think Tom Lee has a lot of great points, and I think me and him are kind of aligned in the near term now from the whole perspective of whether or not we have a soft landing or not. I think we differ on that. I think I'm more in tune with the real economy. And again, I don't think there's any way that we can have this kind of weakness and not get at least close to a recession, right? With markets pricing in 100% chance of a soft landing, 0% chance of a recession, eventually the data will start to turn more mixed or more skewed towards the downside, and markets will be forced to price in more of a recession risk. Some areas have done that. Some areas have not done that. Some areas have been affected by the Fed raising rates more than others, right? So there's a lot of different things that are happening here. And I eventually think we will slip into a recession. Could be in 2025, though. And I do think in the near term, we're going to get data that's good enough to continue to provoke these soft landing expectations. And it almost feels like there's a capitulation going on right now from Jim Bullard, or just look on CNBC. There's a lot of people right now talking about the soft landing has been achieved, trying to declare victory, when in all reality, we're not going to know if this is truly a soft landing, in my opinion, until we get the federal funds rate to neutral, which is between 3 and 3.5%. And just based on the Fed's calibration, that is not going to happen until 2026. So, yeah, it's way too early to declare that there's any kind of soft landing. Way too soon. And that just points to capitulation from my perspective. But in the near term, I do think markets can move higher. Now, the indexes, I'm not expecting much upside. There can be some upside, but 5% give or take, you know, that wouldn't really be too impressive. But I do think Tesla, small caps, value, high-paying dividend stocks, cyclicals, anything that will benefit, long story short, from a perceived soft landing, could see some pretty dramatic upside in the month of September, in my opinion. Perhaps in some parts of October as well. Maybe it's September 18th through the end of September. Maybe that could be a really good period for markets, and for Tesla heading into October 10th. I do think there's a lot that's going to be working for us. At the same time as I am allocated to Tesla, dividends, value, interest rate sensitive, quality growth, I do think cash is king. And I think the longer you have to prepare for a recessionary environment, the better off you're going to be, the more money you are going to be able to save and deploy into markets. So I do think cash is king. And I also think there's a lot of opportunities in our markets in the near term. So let me know what you think about this information down below in the comments section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.